In the vast landscape of Canadian investing, the quest for optimizing investment income while minimizing taxes is a journey that many embark upon, yet few navigate with complete confidence. Understanding the nuances of how different types of investment income are taxed is the first step in this journey. Investment income in Canada generally falls into four main categories: interest, dividends, capital gains, and foreign income. Each type carries its own tax implications, and how one approaches these can significantly influence the overall return on their investment. Interest income, often derived from savings accounts, bonds, or GICs, is taxed at the individual's marginal tax rate, which can be quite steep depending on one's income bracket. This means that every dollar earned from interest is added to an investor's taxable income, potentially pushing them into a higher tax bracket. For example, if a Canadian investor earns $5,000 in interest income and their marginal tax rate is 30%, they could see $1,500 disappear to taxes, leaving them with only $3,000 to $1,500. Dividends, on the other hand, benefit from a more favorable tax treatment. Canadian dividends are classified into two categories: eligible and non-eligible dividends. Eligible dividends, typically paid by public corporations, receive a dividend tax credit that effectively reduces the amount of tax owed. The tax credit varies by province, but it can significantly cushion the tax impact. For instance, if an investor receives $1,000 in eligible dividends, the effective tax rate may be as low as 15% after applying the dividend tax credit, meaning they would only pay $150 in taxes, keeping $850. Capital gains arise when an investment is sold for more than its purchase price. The beauty of capital gains is that only 50% of the gain is taxable. This means that if an investor realizes a capital gain of $10,000, only $5,000 is added to their taxable income. Therefore, capital gains can be a tax-efficient way to grow wealth over time. However, it's crucial to note that capital gains are only triggered when an asset is sold, which introduces strategic considerations for when to sell. Foreign income, which includes dividends and interest from non-Canadian sources, is taxed differently and often incurs additional complexities, such as foreign withholding taxes. Canadian investors must also navigate the foreign tax credit system to avoid double taxation, which can further complicate their tax situation. Given this diverse landscape, Canadian investors have several tools at their disposal to optimize their investment income. One of the most effective strategies is utilizing tax-advantaged accounts, such as registered retirement savings plans, RRSPs, and tax-free savings accounts, TFSAs. RRSPs allow individuals to contribute a portion of their income on a tax-deferred basis. Contributions to an RRSP are tax-deductible, which can lower an investor's taxable income in the year they contribute. The investments within an RRSP can grow tax-free until withdrawal, at which point they are taxed at the individual's marginal tax rate. This tax deferral can be particularly advantageous for younger investors who expect to be in a lower tax bracket during retirement. Conversely, TFSAs offer a different benefit. Contributions to a TFSA are made with after-tax dollars, but the growth within the account is completely tax-free, and withdrawals are also tax-free. This makes TFSAs an excellent vehicle for short to medium-term investments, as investors can access their funds without incurring tax liabilities. For example, if an investor contributes $6,000 to a TFSA and it grows to $10,000, they can withdraw the entire amount tax-free, effectively maximizing their after-tax returns. Beyond utilizing these key accounts, there are several strategies that investors can employ to minimize taxes on their investment income. One such approach is leveraging the capital gains exemption for Canadian securities. The Lifetime Capital Gains Exemption, LCGE, allows individuals to realize capital gains on the sale of qualifying small business corporation shares, farm property, or fishing property without incurring tax, up to a specified limit. This can be a powerful tool for investors in these sectors, effectively allowing them to keep more of their hard-earned gains. Another strategy involves tax loss harvesting, which can be particularly useful in volatile markets. Tax loss harvesting involves selling investments that have declined in value to realize a loss, which can then be used to offset capital gains realized during the same tax year. For instance, if an investor sells a stock for a $2,000 loss and also realizes a $5,000 gain on another investment, they can offset the loss against the gain, reducing their taxable capital gain to $3,000. This strategy not only helps to minimize tax liabilities, but also allows investors to rebalance their portfolios without incurring additional taxes. Investing in Canadian dividend-paying stocks can also be an effective strategy due to the dividend tax credit. By focusing on eligible dividends, investors can take advantage of the reduced tax rate and effectively increase their after-tax income. For example, if an investor holds $20,000 in eligible dividend-paying stocks that yield 4%, they would receive $800 in dividends. After applying the dividend tax credit, their tax liability on that income could be significantly lower than if they had earned the same amount in interest income, allowing them to retain a larger portion of their earnings. Additionally, the concept of asset location plays a crucial role in tax efficiency. Asset location refers to the strategic placement of investments in either taxable or tax-advantaged accounts to maximize after-tax returns. For example, interest-generating assets, which are taxed at the highest rate, are often best held in tax-advantaged accounts like RRSPs or TFSAs. Conversely, investments that generate capital gains or eligible dividends can be more tax-efficient when held in taxable accounts, where they benefit from lower tax rates. By carefully considering where to hold different types of investments, RESPs, investors can enhance their overall tax efficiency. As tax legislation continues to evolve, ongoing education becomes paramount for Canadian investors. Changes in tax laws can have significant implications for investment strategies, and staying informed can help investors adapt and optimize their approaches. Regularly reviewing one's investment strategy in light of new tax regulations can lead to better decision-making and improved after-tax returns. Moreover, seeking professional advice from qualified tax advisors or financial planners can provide invaluable insights tailored to individual circumstances. A knowledgeable advisor can help investors navigate the complexities of the Canadian tax system, identify tax-saving opportunities, and develop a comprehensive investment strategy that aligns with their financial goals. For instance, an advisor may recommend specific investments based on an individual's risk tolerance and tax situation, ultimately leading to a more effective and personalized approach to wealth management. Consider the journey of a hypothetical investor named Sarah. At 35, Sarah has been diligently saving for her future, and she's eager to make her money work harder for her. She starts by educating herself on the different types of investment income and the tax implications of each. Realizing that she has a high income, she decides to maximize her RRSP contributions, taking advantage of the tax deduction to lower her taxable income. Sarah also opens a TFSA, where she begins to invest in Canadian dividend-paying stocks. As her portfolio grows, she becomes aware of the dividend tax credit and the benefits it brings to her overall tax situation. She carefully selects eligible dividend stocks, knowing that the tax implications will favor her in the long run. When the market experiences a downturn, Sarah sees an opportunity to employ tax loss harvesting. She sells a few underperforming stocks to realize losses, offsetting gains from her dividend stocks. This strategic move not only minimizes her tax liability, but also allows her to reinvest those funds into more promising opportunities. Over the years, Sarah remains committed to her financial education, attending seminars and reading up on tax legislation changes. She also consults with a financial planner who helps her refine her investment strategy, ensuring that her asset location aligns with her goals. As a result, Sarah enjoys a growing portfolio, and her after-tax returns continue to increase. In conclusion, optimizing investment income in Canada requires a multifaceted approach that considers the various types of investment income, the benefits of tax-advantaged accounts, and strategic tax minimizing techniques. By understanding how different income types are taxed, and employing strategies such as capital gains exemptions, tax loss harvesting, and focusing on eligible dividends, Canadian investors can significantly enhance their after-tax returns. Moreover, the importance of ongoing education and professional guidance cannot be overstated. As the tax landscape evolves, staying informed and seeking expert advice will empower investors to navigate the complexities of the Canadian tax system effectively. Through diligence and strategic planning, investors can not only minimize their tax burdens, but also maximize their investment potential, ultimately leading to a more secure financial future.